Hello, everybody. Good afternoon, and thanks for joining us this April update of the Codiga Stable Return Fund. As many of you may already know, the fund and the strategy, but I think we should go for a quick review of the strategy. For us at Quadriga, the portfolio we consider portfolio as a team where the manager, the allocator is the coach. The important point is to define a strategic neutral allocation, pick internal and external players, and the important thing is to rebalance the team in an active way. The long-term investment success is not just compounding capital of the offense, but also to preserve capital in turbulent markets. What's the situation, the problem we are facing today? First of all, in cash and money markets, we've been seeing for the past few years and now also real yields pretty low, and this also spreads, these real yields, negative real yields, spread also to some pocket of fixed income and long-term duration, like for example in Germany, the 40-year Bund has been negative up to beginning of this year, and now it's slightly positive in nominal terms. Of course, in real terms, it's deeply negative. The risk reward on the fixed income now, we find it very poorly and not attractive at all. You can get a small amount in nominal terms and potentially also negative in real terms. And the downside now is bigger. You have inflation risk. You have higher yields from the potential central bank. They're going to do some tapering. So that for us, the fixed income, also long-term fixed income, is not attractive, at least especially in Europe. Then if you go towards credit and high yield, we see some pockets of real returns, especially in high yields, less volatility, better, let's say, risk reward compared to fixed income, especially in the high yield side, where the duration has been kept pretty low and the spreads are still, let's say, 200 basis points in Europe. So you can still get to 50 basis points to 1% of positive real return, expected positive real return from high yield instrument. And then in the private equity and public equity space, of course, we see still parts of the market where risk reward is attractive and real returns still positive. Of course, we have some issues with valuation in some part of the market, some pockets of the market, and the diversification risk is always there. When things happen, the markets get more volatile. There are few places you can hide being long equity. You're going to suffer anyway, although you can be in the cheapest side of the market and not the most expensive one, but still the correlation is going to go towards one, and you're going to suffer anyway capital losses. So how we improve the situation? What's in our view the solution? You need to define. You need to divide the book, let's say, the portfolio into different components. The first one is to have a defensive component. The second one is to have an uncorrelated alpha generation component, and then we're going to also have the capital appreciation, the capital compounding component, which is more equity related. Each component is defined not by its name, not because you are called fixed income or a bond. We are going to put automatically in the defensive, let's say, bucket, but by the factor. Macro and idiosyncratic factors. So if a strategy or an asset behaves like in a defensive way. So it preserves you capital, it makes you money when, for example, the equity is losing money, then you're going to be you're going to go into defensive bucket. If you're uncorrelated, it means that you don't have any any correlation with either the defensive component or the offensive component, that in this case is more high yield and equity. And this is an example, for example, of an equity player. So the middle is a 0, and the extreme side is a 10 mark. And in this case, this strategy has high sensitivity to beta factor. A mirror of this strategy, it's a defensive strategy, which has a lot of sensitivity to defensive factors. And then we got the alpha factor, which we can see doesn't have any correlation with the right or left extremes, but it has more alpha type of factor, type of correlation and sensitivity. Mixing this thing together, these three components together, and we obtain the stable return, which is at the end is a circle that has sensitivity to all the factors, can be beta factor, defensive factor, and alpha factor at the same time, but without any extreme. And the idea is to generate a strategy that can that can protect capital during volatile periods, and at the same time accumulating compounding capital during normal periods, quiet periods. So if you go, I think you already know the team. If you go directly into the how we build the portfolio, there are 3 objectives. The first of all is to preserve capital. The second objective is to obtain a stable income. And the first objective is to be an inflation hedge. So as a sum up of this chart, what I would say is the stable return, the target of stable return is 5% above European inflation, and try also to preserve capital when markets get turbulent. So how do we do it? So we have 3 building blocks. The first one is what we call the MP3 asset, so monetary policy free type of framework, where central banks are very accommodative, very dovish, and pouring money into the system. But this time around, not like 2008, aftermath of the 2008-9 crisis, what we have also is a huge fiscal spending from at least the developed market governments, US, Europe, and Australia, Japan. So in this new framework, we try to select the assets, the risky assets that can do better than the overall market in this type of environment. This bucket is going to be composed mostly by equity, some also credit and distress, and the target is going to be notional terms between 25 and 50% in a flexible way. The second important bucket is the anti-bubble, which is our tail risk strategy, long volatility strategy. So it behaves as a mirror of the green dots behave as a mirror of the red dots. It's more like a put option. So we have between 25 and 50% of long volatility strategies. And then the rest of the portfolio, which can be up to 100%, with a total leverage of 1.5 overall for the fund, is uncorrelated alpha. So there are strategies that don't care about the market situation. They just need to have a small, let's say medium single-digit returns by the end of the year, and they are going to add value to our allocation into equity and tail risk fund and long volatility strategies. This uncorrelated alpha is going to give a pickup in terms of extra returns we generate every year without giving us much risk in terms of correlation with the other two buckets. And this is why how we build, let's say, stable return. If we go, well, directly into the monthly update, the April update. Okay, it's been a kind of frustrating month this month, April month. So the strategy ended up flat, essentially, with minus 0.1% compared to the European investment grade index, which declined by minus 0.7. So year to date, we are still by the end of April, we're still down 1.5%. Although the first 2 weeks of May has been very positive for the fund again. So that during the month, the strategy we are still in line with our target of European inflation plus 5% annualized. During the month, what happened? We were essentially by mid-April, were very positive, and then we had some, let's say, equity drawdown in some part of the equity bucket, and also the anti-bubble strategy suffered a bit, and let's say we lost the returns we made up to the mid-month, and so it was pretty frustrating. So we ended up the year, the month on zero. On the more longer term, let's say year to date outlook, we are still in line with the, if you see this chart, the blue line, the stable return and Bloomberg, the A-share class, compared to the red line, which is a European investment grade. We are still in line with the returns of the European investment grade, slightly better year to date, and also better than an investment in US Treasury medium to long-term duration, let's say 7 to 10 years. And here, if you see the chart with the attribution on the NAV of the three buckets, you see still the uncorrelated. We are getting some traction. We are adding some strategies by still very low volatility, so it's not contributing much yet. And the big bulk of the contribution are still the long volatility and the equity buckets. As you may see, April has been also, it's not just by the chart, but also in the table below, the long volatility strategy lost during the month other 1%, and the MPF assets made 1.3. So overall, they offset between themselves. So this has been the month, and also year to date has been kind of a mirror. If you see the same table above, the anti-bubble close minus 4.2 by the end of April, and the MP3 assets was 4% up. The uncorrelated just contributed 20 basis points to the strategy. So that's why we're still kind of negative and not performing. The bulk has been the anti-bubble. So on the good news side, let's see what's going on here. As you may know, anti-bubble is mostly a good part of the anti-bubble factor or driver is also gold. The good thing, as we also anticipated last month, is that we were starting to see a potential recover from gold, which happened this month, let's say during late April, and let's say late April and May, continuing rebounding. And the other positive thing for us in the short term, of course, this new positive correlation between gold and our equity bucket. So it means that in an optimal scenario where equity is stable, not very volatile, or receiving big drawdown, with gold less negative correlated, also let's say zero, not correlated at all with the equity market, can start to deliver some performance. Positive performance. It is going to be very powerful for the fund because we can potentially make money on both anti-bubble and keeping our profits on the equity side. So if we see more the bigger picture in terms of correlation, this is the first chart. The correlation between the equity bucket and our long volatility anti-bubble bucket now is from the very low level, minus 50% in February, March, now is becoming less negative and is getting to minus 30%, 30. So it's less negative. So what this means? So this, of course, has been driven also from gold, mainly for gold. This can be, as I already said, a good catalyst for the fund, for the returns of the fund in the short term. So that's why we think it can be a good timing also to invest or invest more in the strategy in stable return in the short term. But I want to anyway underline that in the long term, this relation doesn't mean that anti-bubble, the long volatility, is useless, and when bad things happen, we are going to lose money, because anti-bubble is not very negative correlated to the equity bucket. So we did sort of stress test, back test of the current exposure of both buckets, anti-bubble and equity. So we replicated the current exposure through factor analysis, artificial intelligence analysis. We replicated the both buckets, and we tracked what would happen in crises like 2008, 11, 16, 18, etc. So we see that, for example, in the same portfolio today, the sensitivity of the portfolio today, coming into 2008, the correlation was more or less slightly negative, like it is now, 20%. And then during the bad period, the bad months, the correlation went from 20%, it dropped, the chart below, sorry, it dropped to minus 80%. The same happened during the first quarter and also up to June, July in 2016. If you remember, we had a tough first quarter in 2016, and then also a tough June due to Brexit. And the same happened again in 2018, especially the last quarter of 2018. And in 2020, the good thing is this was already pretty negative correlated coming to COVID. So gold was pretty negative correlated to the equity bucket, and also long volatility strategies were already negative correlated to buckets. So this strategy entered into 2020 already with a structured negative correlation of more than minus 60%. So this is just to this is a good analysis, just to underline that we also keep monitoring the factors that every moment in the short term we have into the fund, into each bucket, also uncorrelated, equity, all the buckets. And then we can track what would happen in the past, having the sensitivity we have today. Not just in normal times, but we want to be sure that the sensitivity we have today can be useful if a sudden crisis comes, if a sudden drawdown of the market comes, and we want to be sure that the current allocation can be a defensive allocation in case a drawdown in the market, in case markets can get more turbulence without us expecting them to be, of course, unknown type of risk. So I think this type of analysis we do every day, or ad hoc customized strategy every time we want to analyze. So we spend good part of our daily work, doing new models, analyzing the risk of the fund, what could be the potential new risk where we can lose money. This is one of the type of output, this analysis on the chart below. And here it's just to finalize the current allocation by the end of April. The good point is we diminished the Japan allocation. As you remember, we started the year very well exposed in Japan as a top position of 14%. Then Japanese stock was not much going anywhere. Kind of technically was a cap to this resistance level at 30,000 for a Nikkei. So we lowered the exposure, first lowering through future, and then what we did essentially, we exchanged future for a call option, long, let's say medium term call option on Nikkei, 29,000 strike. Why we did so? Because we were scared that in case of new volatility coming, Nikkei was had this cap on the upside at 30,000, and Nikkei is pretty volatile. We didn't want to add volatility to the fund. We wanted to take out some volatility. So we also, with the call option, we felt sure that the maximum we can lose was the premium. And in case of a continuous drawdown, also the delta notion of the call would diminish day by day. So at the end, it was a way not be fooled, let's say, but a market risk. So we saw this in the last few days now in May, where at the end Japan lost 6%, and we lost way less thanks to this call option instead of having a future. And also we were lucky also not to have anymore the 15% exposure we had at the beginning of the year. Said that we also added a small risk reversal through option on Europe just to lower the exposure to Europe. So it worked pretty well to lower our volatility in this last few days of volatility in Europe. It's very short term. We lowered the exposure to Euro stocks by half. And that was through optionality. So this is for MT3 assets, but let's say still with a 30% exposure. Then on the anti-bubble, still the same. We have still the two strategies and combined together 22% of the book. And then on the uncorrelated, we are making few changes. So we saw the NANA strategy, risk arbitrage strategies, and now by the end of April, it still appears with just 40% allocation, but now we are in 44% allocation because we added two new strategies. One strategy is commodity premium strategies, risk premium based just on commodity, ex precious metal. So we're not going to have other gold exposure or silver exposure, which we already have in the anti-bubble bucket. This strategy essentially goes long backwardation commodity that are in backwardation, and short commodity that are in contango. Long-term performance has been very good, and it shows also defensive character. So it's kind of uncorrelated with an alpha coming more from defensive factors rather than offensive factors. And this is the first strategy. And the second strategy we add is an internal strategy, a new strategy that we recently launched. It's a long-short equity fund managed by the two top PM. One is a German PM with 25 years experience and more focus on core Europe and globally US, Australia, and Canada. And the other PM is a Spanish and 20 plus years of experience in asset management and hedge funds. And it's going to be more focused on continental Europe, peripheral Europe, Italy, Spain, some France, and some shorts also in US. So the bias of this fund is going to be a long bias, but once we adjust for the beta can be also around 0.5. And the good thing of this manager, they're both independent. So it's a 2 PM role, 2 PM strategies. Both of them 50-50 split of the notional. and we do an overlay of the risk management of the VaR attribution of each PM. And the good thing of the strategy is that what we want to play is a dislocation. A dislocation we see in the market where there are things that already may be considered cheap with good dividend yields, good free cash flow yields, and there are other type of other stocks in the market that are very expensive, also after adjusting them for the potential growth. So also, if you include in our discounted cash flow or our business models high returns in terms of top line returns and revenue returns, this strategy, these stocks, they look pretty expensive. So it's a long short strategy which aims to play a dislocation. So this for the month. Thank you very much for your time, and I look forward to updating you next month. Thank you. Have a good rest of the day.